It's middle of June. We thought it would be good for us to give you a mid-month update as a lot's happened in the first couple of weeks of June. We had a big Fed meeting earlier this week, and 75 basis point hike has definitely put some things into context for us. And we want to talk about that. We also want to talk about the rapidly deteriorating economic data that we're seeing and what that means potentially for recession indicator and for just a general slowdown and for inflation. So let's take a look at the technicals. Just as a reminder, today is June 16th, so right before market close. These numbers were struck this morning or earlier.
Yep, markets are moving quickly. We have here different flavors of U.S. equities and their performance or lack of performance year to date. You can see the S&P 500 is the dark blue line. It very briefly went into a bear market, down 20% from the high in mid-May, then recovered towards the end of May. And then you see another leg down for the S&P 500, about 10% down here to start June. So now firmly in bear market territory. Not all equities created equal. So high dividend yielding stocks in the US down 11%, represented by that purple line, the FTSE High Dividend Yield Index. And then leading the way down has been growth stocks. So the NASDAQ 100 index, which is very heavy in infotech, consumer discretionary, healthcare, growth-oriented type companies, those down over 30% now year to date.
So one of the factors that has been leading to some of the sell-off is the continuation of inflation, and then yesterday's 75 basis point hike, which quickly became consensus as we've seen the inflation data roll in and not decelerating as we had expected it would, and as quickly as it would. So let's take a look at the next chart and talk about the inflation data and what we see.
Yeah, headline CPI, which includes food and energy prices, up 8.6% year over year as of May. That is a new cycle high for headline inflation, and that definitely beat expectations. The expectation was for something around 8.3%. And more broadly, it was expected that headline CPI had peaked in March at an 8.5% year over year print, and clearly that was not the case. So the food and energy component of CPI, food and energy prices, causing headline CPI to continue to push higher. And then we have the green line, so that's core CPI. That came in at 6% year over year. You see that has started to roll over, thankfully. That was still a little bit hotter than expected. The expectation there was for 5.9% year over year. So, clearly it was too early to call a cycle high in inflation with the May numbers. And you can see these numbers beat expectations. Those red bars show the inflation numbers coming in hotter than expected.
Yeah, and anecdotally, I just, on my way back here, stopped for gas and paid $7 a gallon.
Wow.
So that's a first in my lifetime. And I think Mike just got an electric car, so you don't have to buy gas anymore. Let's turn to the path of inflation we see from here. So our projections going forward.
Yeah, and we've been in this high and rising inflation environment. So this is CPI year over year, and we still are somewhat confident that due to the strong base effects, due to the slowing of core CPI, and then also due to the slowing in economic growth that we're starting to see now, we are still reasonably confident that we're going to move into a high and falling inflationary environment. And that's what you see with the dashed blue line. Might have been a month, 2 months, maybe even 3 months early on that. But it does seem like, based on what the Fed is now prepared to do to fight inflation, that it really is just a matter of time before inflation moves from high and rising to high and falling, which should be a turning point for the bond market. Bonds typically perform well in a high and falling inflationary environment.
And we're seeing some of that today, also anecdotally. But let's go to the next chart and talk about the significant change in the Fed funds futures curve based on yesterday's meeting and 75 basis point hike.
Yeah, this blue line is what the market expected the path of the federal funds rate to be going out to early 2024. And this was what the market expected with all the data they had as of the end of May. So before the May inflation print came out. Shortly after the May inflation print came out and it was hotter than expected and the inflation breath was broader than expected, you saw the blue line jump up to the green line. And so a very dramatic shift. So you see the December 22nd Fed funds expectation moving from 2.62% to 3.5% by the end of the year. And first the market moved and then the Fed followed. And that's where, consensus coming into the June Fed meeting was a 0.5% increase. Once that May inflation print came out, it quickly went up to 0.75% increase in the federal funds rate. And the Fed ultimately just delivered on what the market was expecting.
Yeah. And what has this done to mortgage rates? Have we looked yet?
Yeah, they're rising.
They're rising. I mean,
Yes.
they were rising already, and they were over 6. They crusted over 6, so it looks like they're going to continue to go up. Let's talk about one of the other big elements of our framework is liquidity, and it's probably one of the most foundational things in markets is understanding how liquidity is working and whether it is expanding or contracting. And in this case, our estimate or our look here shows that it is contracting rapidly.
Yep. Yeah, dramatic slowing of money supply growth expected over the next 12 months. And, what's incorporated in our model for money supply growth are expectations for the federal funds rate. If the Fed hikes interest rates faster, more aggressively, that is going to slow money supply growth even faster. So as we updated our model with new projections for the federal funds rate, what you saw was an even sharper slowdown in liquidity as we get towards year end. And liquidity, a low and falling liquidity environment is bad news for stocks, particularly growth stocks. We already see that reflected in financial markets. And it is then a bad thing for economic growth. That is the purpose of Fed funds rate increases, to slow economic growth, to allow inflation to come down.
Yeah. So a question that I get posed a lot is, well, there's still so much money out there. Slowing liquidity isn't going to matter because there's just so much money and everybody has money. So there's nothing to worry about. The consumer's fine.
Yep.
Give us the take on that question.
Yeah. So if we have the exact same amount of money in the economy 1 year from now, then you would say, well, we have maybe the exact same level of GDP growth 1 year from now, or maybe the exact same level of asset prices 1 year from now, maybe the exact same level of earnings. And unfortunately, that's a very bad outcome. The entire economic system is predicated on growth year over year, quarter over quarter. That's why growth of the money supply is so important. It needs to be growing because that allows savings to increase, spending to increase, earnings to increase, economic growth to increase. If all those things stop or even go negative, that's a recession.
And what impact does sort of the wealth effect destruction have on liquidity and the psychology of the consumer?
Yeah. So when the Fed is increasing the money supply, they're lowering interest rates, they're buying assets. They're trying to stimulate economic growth through something called the wealth effect. Businesses can roll over their debt much easier for lower interest costs. That allows them to take on more debt, expand, et cetera. Consumers, individuals that have financial assets, generally they'll see the value of those financial assets go up, which makes them feel wealthier, which means they're likely to spend more. And the exact opposite of everything I just said is true as well. So when the Fed is hiking interest rates and they're reducing the size of their balance sheet, you get a negative wealth effect. And that makes people feel less wealthy or even poorer, and they spend less.
And then the knock on is they spend less, and we see our next chart, which is the GDP forecast. So spending less, since GDP is 70% of our, or spending 70% of our GDP, impacts the growth outlook, right?
Yep. And
So where is that trended?
yeah, well, we know the Q1 GDP print was negative 1.5%. And so we are very closely monitoring what expectations are for Q2 and how the Q2 data is coming in. And so this is the GDP Now forecast. It tries to give you an advance estimate based on the data we've seen since the end of April, what that Q2 GDP number is likely to be. And that's that blue line. And it has trended down to 0 now. And you can look at the individual components and how they've changed from late April to the most recent reading, which is mid-June. And it's been pretty broad-based. Pretty much every component of GDP has had a negative change or slowing since the end of April. Some of them have even flipped signs. So consumer spending, that was one thing that everybody could point to and say, hey, the consumer is resilient. They're going to spend through this. Well, the estimate is that they're going to contribute far less to Q2 GDP than they did during Q1 or than they were even expected to during April. And then you see residential investment has actually flipped negative, which is pretty dramatic given how strong the housing market has been. To see brokerage commissions starting to slow this dramatically because sales activity has grinded to a halt. Housing starts lagging dramatically because houses can't get completed and construction spending starting to get curtailed. All those things starting to weigh on residential investment.
Yeah, and so taking this chart at face value, how volatile is this number regularly?
Yeah, so it's an imperfect estimate. It just takes the data we have thus far and projects out what GDP might be. And we're still a little over a month away from the BEA's first advanced estimate of Q2 GDP. When you're about a month away, this model historically is off by plus or minus 1.5%. Plus or minus.
Wide enough to drive your new electric car through.
That's right.
Okay, so let's move forward, and so we've got inflation that's still cresting. We've got GDP growth that's slowing. We've got money supply that's slowing dramatically. Now we have recessions, and our recession indicator has been very volatile of late. So let's take a look at where it is as of today.
Yeah, right now we're at 50.9% probability of recession over the next 6 to 12 months. This is a new high for the year. There was one time in mid-May when markets were also down 20% or more, roughly 20%, where the recession probability was around 50%. But we now have 2 readings year to date at or above 50%, which certainly is not great news. I mean, historically, 50% called it sort of the line in the sand. Usually at that point, the sentiment has deteriorated enough and there's been enough bad news that an economic slowdown or recession almost becomes self-fulfilling. So we're just now at that point, and it's been very volatile. So it's too soon to call, but we are just now at that point, and we can sort of see as we look through the data points that go into our forecast, what's breaking down and what's holding up still.
Yeah. So natural question. Let's say we are at the point and the indicator goes off here. We're already down 24% on the S&P. How much more downside do you get?
Yeah. Well, the recession indicator gives you a pretty good lead on recessions. And if you study how the market front runs recessions, normally what you get, everything's moving way faster now than it has previously, but normally what you get is the markets give you a recession warning shot where they may go down 20% or so from the peak. And then, things look relatively cheap. The economic data that's lagging, the labor market continues to come in okay for a while. And you have maybe 3 to 9 months of markets moving sideways and being very volatile. And then that last 3 months before the recession is typically when you see the next drawdown, which is usually about another 20%. So
we look at just bear markets in general. I mean, if we look back in history, we've seen some that are, I think of the recent ones, 20% was back in the 90s, but we've some that were like 2008 was 57%. Are we in that type of window here? Are those good bands to think about?
Yeah, once the economy goes into recession and it's clear that there are excesses built up, it's very tough to say whether the market's going to stop at 35 or 55%. The volatility is so incredibly high. But typically, if there is a recession, that's your sort of range on the S&P 500, anywhere from 35 to 55% drawdown.
And have we had a recession that has had inflation running this hot as we go into recession?
Yeah, not since the 80s. During that time period, inflation actually kept moving higher as the economy went into recession.
So a lot happening here. In terms of what we see the Fed doing from this point forward, they raised 75. They said 50 to 75 might be appropriate at the next meeting. The market's saying, obviously, front running that. What is the path that we see going forward, and when could or what would cause the Fed to stop?
Yeah. The markets have been leading the Fed. The Fed's just been catching up to what the market thinks in terms of where they should bring the federal funds rate. So it's been a great lead. The markets, the Fed funds futures market right now is saying the Fed's going to need to get the federal funds rate up another 2% by the end of the year. So there are 4 meetings left. So let's just say 50 basis points at each of the next 4 meetings. They might do 75 at the July meeting. They might do 25 basis points at the December meeting. But at least about 2% more in terms of rate hikes through the end of the year. The cycle is expected to peak in spring of next year, with the Fed funds rate topping out at somewhere around 3.8%. From there, it is consensus that the Fed will be cutting. They will be cutting interest rates through 2024. Normally, interest rate cuts are reserved for recessionary periods. So this is very interesting where the Fed funds futures market, which has been spot on and leading the Fed, is not only calling for more aggressive rate hikes, they are also calling for pretty aggressive rate cuts as we get out into later 2023 and 2024.
Right. Probably largely dependent on if we go into recession, how bad it is.
Yep.
Okay. Well, so that's our mid-month update. And if you have questions, you want to discuss any of the items, certainly let us know. We will be back at the end of the month with the June recap, and we'll tell you what we've seen in the last 2 weeks of June and what we see going forward. So thanks for joining, and take care.